first of all, just consider the advantage of being alive during a time when the best investor of the history of the world is alive and running a public company that you can just buy. And
it is amazing.
And he's paying himself, I believe, still technically $100,000 a year. Okay, so you just receive the top expert in the history of the world, and it's totally free. So for people that aren't eligible, we have accredited and qualified investors that meet the requirements for our fund, but other people come to us and they ask, what should we do with the capital? And almost entirely, I've told them to split it between S&P and Berkshire and then go do something else with their time. And those investors who follow those instructions do really well and also get to have all their time to go enjoy the rest of their life. So it is a totally reasonable strategy to just buy a huge position in a Berkshire Hathaway, walk away and never touch it. It's going to be just fine. And it probably beats the S&P 500, which, as you know, most professionals have a difficult time achieving.
Talking actually about Berkshire Hathaway and even talking about 13F filings from before, just quickly, I want to get your take on Warren Buffett selling his Apple shares, or he sold 50% of Berkshire's holding. Do you have any thoughts on that? Because interestingly, he's halved it and he's sold down to exactly 400 million shares, exactly, which leads me to believe that he's done selling.
I think it's a coincidence. If I had to project, I'd say at the time, right now, I do think he's probably done selling. But I also know it would be very strange for him to trim. That is not a normal thing for Warren Buffett to do. So perhaps he was looking to get a little more cash together. Maybe he has something in mind and he needs the capital. Also, Apple has run up quite a lot. Obviously, it's been an incredible investment. And I do think that Berkshire, in a way, has a real fiduciary responsibility to manage. They have claims and obligations and shareholders. And if it really became totally dominated by Apple, Buffett may feel a responsibility to make slight adjustments. But it's really, you let your flowers run. It's such a strange concept for people to grasp. And I think it was Munger. It could have been Peter Kaufman who put it out in this way. But I like the analogy, which is like if you're sitting around in your master's class or you're sitting around in your undergrad and somebody gives you a pile of money and says, okay, you're going to buy the future earnings. You're going to buy 10% of the future earnings of 3 students in your class. And you're not going to be allowed to change it. Okay, so you're going to go around your class. You're going to think very hard about who's going to maximize their earnings over the future of their lives, because that's what you're going to be buying. But then imagine you go forward 20 years and 2 of these students you've selected are earning millions of dollars a year and everybody else is earning a more reasonable income. And suddenly you look around and you think like, well, I've done so well so far. I'm pretty sure that I should take my money out of these and I should go and apply it to some of these others that haven't really bloomed yet. Well, that would be totally wrong because they're not going to bloom. You're already parked in the right vehicles. They're doing what you should be, and making that switch would cause, in many cases, tax liability. You'd end up with less capital than you'd start. You'd reinvest in a worse company. You'd have less knowledge about that new individual. You've known your original investment for now 20 years and you're watching their success. You now go to an unknown entity. So it is those types of reasons why I would not expect Warren Buffett to generally be trimming. But in this case, I sort of agree with you. It got so large, and I don't know if he wants all of that exposure or volatility. I don't think we're headed for an immediate recession at this time, but we're right now on the brink of interest rates starting to come down. And we don't really focus on these macro events, but Berkshire has although Warren often says you can't time the markets, he has been an extraordinary market timer over his lifetime. And how does he do it? I think the real way that he does it is he's analyzing opportunity costs relative to all the other opportunities He's also incorporating the opportunity costs throughout history and potential opportunity costs in the future. And when he doesn't find something compelling, he's disciplined enough to put $280 billion in cash into an account and wait for years until there is that opportunity. So I think that in the long term, everybody will find that Warren Buffett made a smart decision again, whatever it is that he's doing. The nice thing is that you own Warren Buffett and Berkshire Hathaway. You don't even need to know exactly why, but it is generally probably a very good decision. And so, although no, we can speculate. We don't know if he's going to keep selling. It's not public information. I think he really likes his Apple holding. I don't think he's going to just sell all of Apple, but certainly trimming, and it's interesting to watch. There are a lot of interesting things that happen in Berkshire Hathaway, a little like Daily Journal. I think if you own it, you go to the meetings. I derive a lot more than just the financial value out of Berkshire Hathaway. There are these aspects of investing, and I'm sure you encounter it as well. If you buy a great firm and it's owned by another manager that you have respect for, et cetera, now you end up in a conversation with that manager. Now you're sharing these ideas back and forth. This is personal value that's even more than the financial value. So you can learn things from your various holdings. You can find all sorts of ancillary things. And through the ownership of Berkshire, through the ownership of Daily Journal, I think it makes us truly better investors. And I'd say right now, if you had to ask, I mean, there are many favorites throughout the fund's history, but Seritage has been a favorite as well.
That's an interesting one. I don't follow Seritage closely. Can you kind of tell me the story of that and how that all panned out?
So Seritage is a REIT.
Right. Real Estate Investment Trust.
It's a real estate investment trust. And the REIT consists of the ex-Sears malls that were spun off of the Sears entity before it went bankrupt. Okay, so to give you a little more context, in the 90s, actually now I'm thinking it's 2004, but in many years ago, Eddie Lampert, who was once thought of going to be the next Warren Buffett, decided to combine Kmart and Sears just pre-Amazon. Okay, so brought these two behemoth retailers together. And what happened is Amazon took over and they had lagging sales and it did not work. All right, so before Sears filed their official bankruptcy, because Eddie Lampert's a brilliant financier. So he was able to take all of this real estate that had a huge amount of value and create this sale leaseback model where they sold they put all the real estate into a REIT, and then the existing Sears stores began leasing from the REIT, and then Sears went bankrupt and he preserved all of the real estate value. And at that point, there were around 212 malls, and the price of Seritage was all over the place. And Warren Buffett bought some, and some great investors bought some. We were looking at it, and when we were first looking at it, we do these things. It's as simple again, but it's not easy. When we needed to figure out the value of Seritage, we had to look at, what most were doing, what basically anybody doing a lot of work was doing, was trying to figure out what malls were Class C, Class B, Class A, and cap rates, and sort of these generic assessments. I started with Andrew, our analyst. This is years and years ago, and we just started figuring out the value of every single property. And we went one by one. We figured out the value of 212 properties, and
212.
Yes, and they take a long time because they're all unique. All right, so it's phone calls. We would triangulate between brokers, and what that then occurred is Seritage began this process. Let's fast forward a bunch of years. They were trying to grow them. At one point, it was compounder, and it looked like a great opportunity. So we were taking a position then. They then went into a liquidation period where they decided these malls are They don't want to manage these malls internally. There's more value that can be created if they just liquidate the company and pay all the shareholders out in dividends. And when we looked at that, as the mall count started shrinking, it became much easier for us to have a really good grasp on what these values were. Because one, they were selling malls that we had previously valued. So now we could check our work. And two, suddenly, like today, there's just 22 malls left. 22 to
They've
us.
sold most of them.
Yes, out of 212, they've sold 190. All right. So now with 22 malls remaining, it is so easy for us to sit and look. And they have some really nice Class A properties. They have UTC in San Diego, which is like $110 million mall when they sell it. They have Adventura, Florida. It's one of the greatest malls, and it's like a $200+ million mall when they sell it. So if you add up, so it's so simple. If you add up the last 22 malls that they're selling, and you subtract the basically 280 in debt and like 70 in preferred debt, which is 350 million. When you remove those and we look at about 100 million cost to complete the liquidation, there's still a lot of value left. And so it's very interesting. You can just divide by the shares outstanding, 56 million shares, and you can see, oh, okay, it looks like we'll get about $7 per share, but I'm not recommending to buy this stock. It's just a fascinating story. We don't own it. By the way, we exited around. We exited around 11. Okay. We ultimately purchased a little below 6, I believe. Maybe it was a little above 6. We only held the shares for about a year, but we watched this so carefully because we've been counting and valuing these malls for so long. And the price is just fascinating. For people that think the market is efficient, just go and watch Seritage. It's definitely not efficient. There is a intrinsic value of these malls. These malls are not having more malls. These malls are not growing square feet. There's nothing happening. Most of them are empty. So there's no cash flow. They just need to sell the malls.